Section 10-4 is entitled More About Project Cash Flow. It starts out with some explanation about why net working capital needs to be considered as discussed. And I'm not going to go through that, but I recommend it to you. Go through and see exactly what the point is of considering net working capital as our outflow and as a potential inflow at the end. The first couple of pages of this chapter address that. And then we get to depreciation. And as I mentioned in the preview for Chapter 10, we're going to be using the modified accelerated cost recovery system. That's a depreciation method. It is specified by the IRS, and it uses specific classes of assets and depreciates them over specific years of time. So there's 3-year class, which is equipment used in research, 5-year, autos and computers, 7 years, most industrial equipment. As I mentioned in the overview, 3-year is actually 4 years. Again, the reason is because you don't start on January 1st buying your equipment and then depreciate it evenly in the 3 years that you use it. Instead, the assumption is that you buy it sometime during the year. Now, you may object and say, but I did buy it on the 1st. Well, that's too bad. This is the way it works. And again, you notice that the sum is 100%. The sum of the 5 years 100, and the sum of the 7 years 100. In other words, you depreciate it out over its entire life to a zero value. That means in calculating the depreciation amount, you don't start by assuming that there will be a salvage value. And I use salvage value 2 different ways. One is the number that you use in calculating depreciation. We don't have to deal with that when we're using a modified accelerated cost recovery system. The other is that it actually will be worth something at the end, your equipment. So you'll consider that what if we sell it at the end and it's worth 0 on the books because we've depreciated it down to 0, then what will we get for it when we sell it? And what you'll get for it is whatever you sell it for, less the taxes that you have to pay. In our problems, we're going to assume that you've depreciated it all the way out so that it's worth 0 on the books. So whenever you sell it, your entire sales price will be profit. Now, we don't call it that. We call it recapture of depreciation. But, for example, if you sell it for $100,000, and if the tax rate is 21%, then you'd get $100,000 when you sell it, but $21,000 goes out as tax, so you really net $79,000. Here's an example: $12,000 equipment in the first year. This is a 5-year equipment. In the first year, it's 20%, and 20% times 12,000 is 2,400. Then 32% times 12,000 is 3,840, and so forth all the way down. And when you add up these numbers, you get a total of 12,000. And when you add up these numbers, you get a total of 100%. We won't deal with bonus depreciation. It's not a factor anymore. Book value versus market value. Well, when we're writing these things down over time with depreciation, what we show in the books is book value, which may bear no resemblance to market value. Market value being what could you sell it for. On page 324, we show what happens to the book value of this asset as you depreciate it out. So in the first year, we had $2,400 worth of depreciation. We started at the beginning with $12,000 worth of book value, subtract the $2,400 of depreciation, and we have an ending book value for the end of the first year of $9,600. That becomes beginning book value for the next year, and depreciation in that year is over here $3,840. So $3,840 subtracted from $9,600, $5,760, and we keep on going. And if you were to sell the item before the end of the project, the projected end of the project. Let's say if we sold it right here. Then whatever we sold it for, we would subtract what it's worth on the books, the book value, and we would have to pay tax on that difference. So we would get the entire amount of the sale price, but we'd have to pay tax on the difference between the sale price and the book value. Now the biggest part of this section, and it is very big, is this example of the Majestic Mulch and Compost Company. This is a much more complex problem than the one that we looked at in 10.3. So let's go through it. They're projecting unit sales, and unit sales means if you're selling let's say basketballs, a unit would be a basketball. That doesn't mean the dollar amounts of sales, it's just the units of sales. So here are our projections, and those of you who are in marketing, you're the ones who come up with these numbers, so we have to rely on you. 3,005, 6, 6,500, and you see that in the first year, it may be that this, first it's only partial year maybe, but also it may take a while for this particular product to catch on. And it does catch on, and finally we get up to 6,500 units per year in the fourth year, and then it starts declining. Now it could be it's declining because other competitors come in with products and undercut the price, and so they sell some units that you would have sold and so forth. We don't know, but this is the projection. Now it says here that we're going to sell them for $120 per unit initially, but when competition catches up after 3 years, the price will drop to $110. So now, unlike that earlier example, we have one set of unit sales and it's all the same every year, and one price and it's the same every year. Instead, we have different unit sales and different prices. We require $20,000 in net working capital like we did in that previous project. However, this has a big complication. Subsequent to the first year, net working capital will be 15% of sales for that year. So every year we have to figure out what is our level of sales, and our net working capital will have to be 15% of that. Variable cost per unit is 60, and you notice that that doesn't change, and it's probably reasonable that it wouldn't change. Fixed cost $25,000 per year. $800,000 of equipment. It qualifies for 7-year makers, and we assume no bonus depreciation. It'll actually be worth 20% of its cost in 8 years. That is, we're going to be depreciating this all the way down to 0, but we think it'll actually be worth $160,000 at the end. And as mentioned before, we're going to end up selling that and paying tax on the sale price and keeping the difference. The relevant tax rate, 21%. So what we're going to do is plug these numbers in like this. Here's our table of unit sales. That's this table right here. And so here we have all of our unit sales. And then we have our unit price. And you recall the unit price was $120 to start for the first 3 years and then drops to $110. So every year we can calculate our revenues as the unit price times the unit sales equals total revenues. And we do that for every single year. So now we have revenues. We also can calculate our variable costs. How much are our variable costs? Well, $60 times the number of units. We're going to take these revenues and we're going to drop them in here. Here's our revenues: 360, 600, 720, 715, 660, 550, 440, and 330. All we're doing is taking this little table and showing those numbers on the third line as revenues. The variable costs are $60 per unit times the number of units. Well, if we have 3,000 units in year 1, 3,000 times 60, 180,000. 5,000 times 60, 300,000. 6,000 times 60, 360,000, and so forth. So that's our variable cost. So we've got revenues, we've got variable cost. Our fixed costs were given to us as 25,000. And so we subtract 25,000 every year. And then our depreciation. Well, here's our depreciation schedule up here. We have a total price of 600,000, the cost of putting it into operation. And the first year it's 14.29%. Well, that's the number that comes straight out of the depreciation table over here. 14.29, page 323, 14.29%, 24.49, 17.49. The question that's typically asked about now is, are we supposed to remember all those percentages? And the answer is no. If there is a question that requires use of this, you'll be provided a table. So we're multiplying the percentages times the dollar amount to get the depreciation amounts, and we show a declining book value as we go along. That is 800,000 minus 114,320 is 685,680. Subtract from that 195,920, and we get 489,760, and so forth. So depreciation, these depreciation amounts we show down here all the way across. 114,320, 195,920, 139,920, and so forth all the way across. And once we have that, we can subtract revenues minus variable costs minus fixed costs minus depreciation gives us EBIT. And we have to do it for every year because these numbers are different in every year. So every year we have a different EBIT. And then we calculate our taxes, and our taxes are based on a 21% rate. So 40,680 times 21% is 8543. Subtract taxes from EBIT and you get net income. And we do that all the way across. So here's our set of projected net incomes. This is our pro forma income statement for all those 8 years that we project. So here we're showing operating cash flows, and we're taking the EBIT straight across from over here. So 4680, 4680, 79080, 79080, 195,080, 195,080. Just rewriting them straight across. And then since it's operating cash flows, we're going to take EBIT plus depreciation minus taxes. So we're going to take this whole line over here, depreciation, 114,320, 195,920, 139,920, and so forth all the way across, and our taxes, 8543, 8543, 16607, 16607, straight across, and we take EBIT plus depreciation minus taxes, and that gets us our operating cash flow for every single period. Now, net working capital was kind of complicated. It said that we were going to start with initial net working capital of 20,000, and that would be an outflow because we have to put in the money into this project so that we have working capital to just to get the thing started. But then it said that the net working capital will be 15% of revenues for that year. So we start by putting in 20,000. Thereafter, it's equal to 15% of whatever revenues would be. So what we have for the first year is 360,000 in revenues, and that's just this number over here, these numbers here. So we've got revenues for each year, and we're multiplying that column by 15%. So 15% of 360 is 54,000. 15% of 600,000, 90,000. 15% of 720, 108. And now what we do is show, well, what's the difference from one year to the next? So the first year we had a minus 20. The second year we have to have a total of 54, so we need another 34. 20 and 34 54. The next year we need to be at 90. So that's another 36. To get from 54 to 90, you need another 36 of cash outflow because we're increasing our net working capital every year. And that kind of makes sense because the more you're producing, the more you're selling. The more you're selling, the more, of course, the more you're producing, the more you have to have for inventory, and the more you sell, then the more accounts receivable you're going to have, and the more cash you're generating, and so forth. So in the next year, we go from 90 up to 108, because 108 is 15% of 720, and that's another 18,000. But after the third year, revenues start dropping, so net working capital starts dropping. And so we go from a requirement of 108,000 to 107,250, and that's a reduction of 750. So that's a positive number. And the next year, 660 times 15% is 99, and that gets us from 107,250 down to 99. That's a reduction of 8250, and so forth. So all you're doing is subtracting here. This number minus this is this. This number minus this is this. And this number minus this is this. But in that last year, we don't just have this 16,500, and that is a return, by the way. These negative numbers are numbers that are leaving us, and the positive numbers are numbers that are coming to us. But in this last year, yes, we are reducing our requirement down to 49,500, and that means we have a positive cash flow of 16,500. However, at the end of the year, we're also going to get our 49,500 back because we don't need to have any net working capital anymore. So in that last year, we're going to get both of these. So let's look at the net working capital situation then. In the first period, minus 20,000. The next period, 34. The next period, 36. Then 18. These are all out. And now we come in. Inflows, 750, 8250, 16,500, 16,500, and 16,500. And that last year we get our 49,500 back. So those are all positives. And we just add them up, and for every year then we have the amount. The only year we actually have to add is the last year, and that would be 16,500 plus 49,500 gets us to 66,000. And then what about our capital spending? Where our initial outlay is 800,000, and at the end we're going to have a return of our what was that, 120,000, I think it was, or 160,000 is going to be our actual sale price, and we have to pay tax on that. So we're going to take our 160,000 and multiply it by 1 minus the tax rate. And the tax rate is 21%. So 160,000 times 0.79 is equal to 126,400. So that'll be an inflow when we sell it. Remember, that is the price we sell it for less the tax we have to pay. So now we have our operating cash flows, our net working capital, and our capital spending. We have all three of these things. And now we're going to put them into a single table. So this is the projected cash flows for Power Mulcher project. And our operating cash flows, well, let's start at time 0. We have 20,000 change in net working capital, that's an outflow. And we have 800,000 as capital spending, so our outflows are the sum of those 820,000. So that's our outflow. I'm not too keen on this line down here that says cumulative cash flow. For me, this is very similar to calculation of payback period, and I just view things differently, but if you view it like this, go for it. The second, at time 1, the first year, we have 146,457 as our operating cash flow, and our change in net working capital is 34,000, and there's nothing in capital spending. So we add those up, and it's 112,457. The next year, time 2, we've got 258,393, and we've got 36,000 outflow for our change in net working capital. So we net those out, and that's a little awkward. Consider that we have this much coming in and this much going out. It'd be nice if this minus sign were a little closer, but the point is it's the difference between these. And so that's 22,393, and the next year it's 294,033 minus 18,000, and that gets you 276,033, and we eventually get out here with some positive numbers. So in the fourth year we have 257,983 and 750 that's coming back to us because we don't need as much working capital anymore. So we're adding those two, and this becomes 258,733. Just the addition of these two, and we continue along here until we get to the end, and at the end we have 106,243 and 66,000 and 126,400. So this is a key right here. We're going to get our working capital back, and we're going to sell for whatever the salvage value is after tax. So we're going to have a bigger cash flow in that final time period. Now, if we were to work our miracles with NPV, we could go to cash flow. And as you know, when I'm talking while I do this, it's quite common for me to make a mistake. So let's see how this works. Total project cash flow. That's the line that we're looking at. And I'm going to make sure I don't have anything in here. And then I go back in, and I've got 820,000. Change signs, enter, down. 112,457. Enter, down, down. 222,393. Enter, down, down. 276,033. Enter, down, down. 258,733. Enter, down, down. 240,502. Enter, down, down. 209,236. Enter, down, down. I'm going to hate it if I have to do this over again. 169,752. Enter, down, down. 298,643. Enter, down, down. Our required rate of return is 15%, so I'm going to go NPV, 15, enter, down, and compute. And I get 146,851 I have, and they're off by a little bit. So surely I'm not off. 146,852. And what's our internal rate of return? IRR, compute, 19.86. I didn't show payback, but you can calculate payback, or you can calculate discounted payback. So there's a lot in this section 10.4, and it can seem a bit overwhelming, but really it's just sort of a step-by-step process. Not as bad as it seems. Now you're asking yourself, could he make us do this on an exam? And the answer is, I could make you do a simple version of this. It clearly wouldn't be 8 periods, and it wouldn't have as many variables like all these different net working capital amounts. It wouldn't be that. So it'd have to be a simpler version. But you get the general idea. Important for you to understand that you have outflows and you have inflows. and we're calculating an NPV and an IRR on the set of outflows and inflows. Very important to understand about operating cash flow, and that our cash flows for our project will consider operating cash flow, change in net working capital, and capital spending. Yeah, plug them in and get an NPV and an IRR. Hope that helps. I suspect that almost all of you will want to watch this a second time, and if you have any questions, forward them to me.